In the alternate version of exercise 11-5, we're going to tackle stock dividends and also stock splits. So let's go ahead and jump into it. We're first presented with the equity section of Sharper Corporation's balance sheet, including common stock of $256,000, which is just $8 par value times 32,000 shares issued, paid in capital in excess of par value of $200,000 and retained earnings of $358,000 for total stockholders' equity of $814,000. It also mentions that the stock is currently trading for $30.50. It's asking us to assume, in addition to what we have presented here, that the company is going to declare and distribute a 100% stock dividend. Now, up to this point, when we've used the term dividend, we've known it's a distribution to our stockholders, but we've typically thought it's always a distribution of cash. So we've typically only handled cash dividends up to this point. But a company can distribute something else other than cash, and in fact, it might issue additional shares of stock, which is a stock dividend. Now, how we handle a stock dividend financially depends upon whether it's large or small, and you would have already seen through your LearnSmart that there's a particular percentage that creates the dividing line between large or small, and what is that percentage? 25%. So if it's 25% or less, it would be considered to be a small stock dividend. If it's greater than 25%, which understandably 100% is definitely greater than 25%, it would be considered to be a large stock dividend. And again, that's an important first step, is figuring what category it fits within, because that impacts how we handle this financially. Now, we're asked to summarize in our table the impact on individual components of equity and also the number of shares outstanding. And the good news is the first part just asks us to list information that already exists from the beginning of this problem, is what's our equity before the stock dividend. So all I did is transfer all the existing dollar amounts from the top here. It also asks us to indicate the number of shares that were outstanding prior to the dividend being distributed, and that's 32,000 shares both issued and outstanding. So I'm going to jot down here 32,000. Now we start getting into the tougher part. What is the specific impact of the stock dividend? Now, I think it's a little cumbersome to start jumping in and figuring out, does it impact common stock? Does it impact retained earnings? Let's do an easier point first and gain some confidence here. How does it impact the number of shares outstanding? I mentioned stock dividend is, in essence, we're giving more shares to our existing stockholders. How many shares are we issuing? We're just going to take our number of shares currently outstanding and multiply it times our percentage. So 32,000 shares currently outstanding times 100%, coincidentally, is that we're going to issue an additional 32,000 shares to our existing stockholders. Again, it might seem cumbersome to start building this table, so I recommend thinking about the journal entries. I realize that's not a requirement of the problem or something that you're getting points for, but I think it helps you to figure out the journal entries to understand the impact. So let's go ahead and work through those. So very similar to what you would do with a cash dividend, you're debiting retained earnings, because very similar to a cash dividend, we're removing earnings from the business, so we're debiting retained earnings. But when you do a cash dividend, it's a little bit easier to value that, a little bit tougher when we do a stock dividend, and it depends upon whether it's large or small as to how we value it. If it's a large stock dividend, we take the number of additional shares being issued, so 32,000 shares additional being issued, and we multiply it times the par value. Which, if you recall from here at the top, par value is $8. So $8 par value times 32,000 shares equals a debit to retained earnings, or a reduction to retained earnings, of $256,000. Again, I think it helps to build the journal entries so that we can start thinking through what the impact is on the individual accounts. Now, typically when you did a cash dividend and you're recording the declaration of the dividend, the other side of the entry was some type of liability account like dividends payable. But that was when we were eventually going to pay cash. Here we're eventually going to issue shares of stock, so our credit isn't going to be a liability account, it's going to be an equity account called common stock dividend distributable. We can't yet credit common stock directly because we're assuming we haven't yet distributed them, but we'll credit common stock dividend distributable also for $256,000. Then whenever we actually issue the additional shares, we're going to debit common stock dividend distributable for $256,000, which ends up bringing its balance down to zero, and transfer that amount to common stock. We're increasing it with a credit for $256,000. So again, not a required part of the problem, but I think it helps understand how building the journal entry, how we impact our equity amounts. So retained earnings, here we debited or reduced. That's why you show it as a negative $256,000. Also, we start building this common stock, we're increasing it or crediting it, so we'll show it as a positive $256,000. Our total paid in capital or total contributed capital increases by $256,000. Well, on the other side, our retained earnings decreases by the same amount, $256,000. So total stockholders' equity does not change. An important thing about a stock dividend, in essence, it's a redistribution. It's a redistribution of retained earnings to our paid in capital or contributed capital account. So we're just moving money around within the equity components. So how do we summarize this all together? What's total? This is just the impact of the stock dividend itself. What is equity after the stock dividend? Well, common stock is a combination of the original $256,000 plus an additional $256,000 that got moved out of retained earnings. So now common stock is $512,000. Paid in capital in excess of par value doesn't change. It stays at $200,000. But now our total paid in capital or contributed capital is going to be $712,000. A retained earning decline by an equal and opposite amount. It's going to go down by $256,000. So start it at $358,000, declines by $256,000. Now retained earnings is $102,000. Take our total paid in capital of $712,000 plus retained earnings of $102,000 equals total stockholders' equity of $814,000. See, total equity did not change. We proved that out. It's going to stay exactly the same, but we are increasing contributor paid in capital. In particular, for a large stock dividend, we're just simply increasing common stock. Equal opposite direction of our decrease in retained earnings. Again, just redistributing our retained earnings to contributor to paid in capital. Before I move on, we'll also take a look at what's the total number of shares outstanding. We started with 32,000. We issued an additional 32,000. That's going to give us total shares outstanding of 64,000 in our current shareholders' hands. You might be asking, why in the world would I do a stock dividend? Well, if your stockholders have gotten used to maybe perhaps you issuing a cash dividend, they get used to that, and maybe perhaps things are a little bit rougher now, just having the cash available or wanting to utilize that cash for additional investments, and you're feeling if I don't give them something, it may look like a signal that we're not doing as well. So I at least want to give them some type of dividend to create a positive signal out there of the company. The other reason that you would have learned through your Learn Smart is that we might use this as a tactic to help bring down the market price of our stock. And you might be thinking, that doesn't make sense. Don't we always want to push up the market price? Well, for some companies, the market price gets so high that it becomes unaffordable for a lot of stockholders. And if you think about economics, if the price gets too high, your demand starts to shrink. So maybe I'm not having enough demand and I'm not selling enough stock. So in essence, getting more shares out there, think about it. If I put more supply out there, a lot of times it's going to push the price down, and I may counteract the fact of, lower price by having additional shares that I'm able to stimulate demand for. So that may be a reason for a stock dividend. Now, to this point, I've only tackled one of the two stock dividends, and that's the large stock dividend, and that takes care of half of the requirement for this problem. And while the problem itself doesn't cover small stock dividends, it's something you need to be familiar with. So let's change this problem a little bit And instead of having a 100% stock dividend, let's have a 10% stock dividend. Now, I'll mention real quick, I've left the table up here that reflects how a 100% stock dividend impacts equity individually and overall. So I'm not going to work through, save you a little bit of time, all the steps. But I left it up there so you can kind of compare and contrast. So let's start to work through what the impact would be. Now, logically, you think with a large stock dividend, I started with debiting retained earnings, and that seems like a good starting point, and it is. We're still reducing retained earnings. But our starting point before was taking the number of additional shares being issued and multiplying it times par value. That only works for large stock dividends. It does not work for small stock dividends. The rule changes. We're going to take the number of additional shares, which we started with 32,000 shares outstanding. Take that times 10%. That means 3,200 additional shares are going to be issued. This times we multiply it times market value, what the stock is currently selling for, which is $30.50. That's going to be a total of $97,600 that we're going to debit retained earnings for. Again, this time it's going to be for market value. Very similar to what you did for a large stock dividend, we'll also credit common stock dividend distributable, but not for the same amount that we debit retained earnings for. We're going to credit it for the amount of par value. So take those 3,200 additional shares, this time times the $8 par value, and we're going to credit common stock dividend distributables for $25,600. Very similar to what you do when you actually sell shares of stock. If there's a par value, typically the limit that you can credit your common stock, eventually this will become common stock, for is going to be your par value. So very similar here. Also very similar to what you do when you issue or sell shares of stock to stockholders is you'll take the difference between the par value and the market value and you'll credit it to paid-in capital in excess of par value. So $97,600 minus $25,600 gives us a total credit to paid-in capital in excess of par value of $72,000. Now, I didn't show the entry here. That's when you declare the dividend. When we finally distribute it, very similar to what you did for a large stock dividend, you'll debit common stock dividend distributable and credit common stock for $25,600. Again, the table still reflects the 100% stock dividend, but just wanted to sort of talk through what the difference would be for the journal entries so you have an understanding of that. Very similar to a large stock dividend, though, is this is affecting the number of shares outstanding. It's also just simply a redistribution from retained earnings to contributed capital, but the value is different based on market value compared to par value for a large stock dividend. So let's start from the beginning and start fresh and assume our original equity situation on our balance sheet and also original market price. Instead of doing a stock dividend, we're going to do a stock split. So good news here, I think we saved the easiest for last, is a stock split will affect the number of shares and the par value, but it will not impact any individual component of equity, meaning the dollar amounts for each of the individual components. Equity doesn't change. It also does not impact total stockholders' equity. So there are no journal entries, which probably makes you very happy, right? But it does impact the number of shares and also the par value. So let's go ahead and start to work through here. Let's start before the stock split. It mentions that they're going to implement a 2-for-1 stock split. In essence, what's happening with a stock split is the company is calling back its existing shares from its stockholders, and it's replacing those typically with more than one share. Per each one that it took back, it's typically replacing that with more than one share. In this instance, a 2-for-1 is saying, hey, every stockholder that owns a share, we're going to call that back and give them 2 shares as a replacement. That's what a 2-for-1 stock split would be. So let's start working through here. Again, equity's going to, from our beginning, is going to be a total of $814,000, a total of 32,000 shares outstanding. So before the stock split, how does the stock split actually impact? So let's think about how many shares are going to be outstanding, and let's work through this. We said 2 for 1 says every person that currently owns a share of stock, we're going to call it back and give them 2 shares of stock. So we can take our 32,000 shares currently outstanding, multiply it times the first number, which is going to be 2, so that's 64,000 shares, and then divide it by our second number, which is going to be 1. Again, says we started with 32,000 shares. We're going to end with 64,000 shares. The difference between that is coincidentally, based on the 2 for 1, is that we're going to issue an additional 32,000 shares in order to end up with 64,000 shares outstanding after the 2 for 1 stock split. You may have asked that my formula looks way more complicated than it should be. Can't you just take 32,000 shares, multiply it times 2? That also gets me 64,000. Why am I doing this divide by 1, which is going to give me the same answer anyway? Sometimes stock splits are a little bit more complicated. They're not always 2 for 1 or 3 for 1 or 4 for 1. Sometimes they might be a little bit more complicated. For example, it might be a 3 for 2 or 4 for 3 or some combination like that where the division is not 1, so it's nice to know the formula. So what impact does it have on equity as far as a stock split? We said no impact at all on any of the individual components. We're not making a journal entry. So after the stock split is common stock and all the other components are going to stay exactly the same individually and in total of 814,000. And again, our common shares outstanding is going to increase from 32,000 to a total of 64,000 shares outstanding. Now, a subtle thing that happened that you may not have noticed, remember I mentioned in the beginning, the number of shares is going to increase, but par value is going to decrease. Originally, when I first started out this table, we had the $8 par value listed. And it made sense. $8 par value times 32,000 shares issued is going to be 256,000. And now that has changed. So while the number of shares has doubled, the par value has gone the opposite direction and is half. In fact, we're taking the $8 par value, dividing it by 2 since it's a 2 for 1 stock split, and now the par value is going to be $4. And we can work out the math and that makes sense. $4 par value times 64,000 shares issued and outstanding still equals the 256,000. I think this brings home a stock split reasons for it are very similar to a stock dividend. I may want to create confidence by putting something out there. Hey, you get additional shares of stock. On the other side too, it can push down the market price. So very similar to it push down the par value in the opposite direction, it's going to push down that market price. So very similar reaction, again, to perhaps make it more affordable to perhaps stimulate demand out there in the market.